Hello there everyone, welcome back to Money Conversations with Magical. Today I'd like to speak about an asset class that has gotten some Kenyans financially trapped. I will be talking about land. A few years ago there was a saying that people used to tell each other, buy land, they're not making any more of it. And actually it reached a point that having a title deed became a symbol of success. That if you sat around a group of friends who have bought land and you're not participating in that conversation, you've not bought a piece of land, you'd feel left out. But that is no longer the case. While land in a few places is seeing 13% annual growth, most of the other satellite towns have less than 1% growth. So that cheap, call it cheap, land that you've bought in a satellite town, land you're called and you're told, we are selling a piece of land at 200,000 in some far-flung place, at 100,000 in some far-flung place, could actually be a liability that is eating into your money. I'm talking about liquidity. I'm talking about dead assets. I'm talking about the land trap. So what are dead assets, or what is a dead asset? A dead asset, how I look at it, is any asset that you cannot easily convert into cash when you need it. That's a dead asset. So take a situation or a scenario that you bought a piece of land at 1.5 million 3 years ago in a growth corridor. So you are told there's some road that will be passing here in the next 3 years, or there's an airport that will be built here in the next 10 years, and you bought that piece of land at 1.5 million. Then fast forward today, you get a medical emergency, or you get a business opportunity that requires you to have 500,000. So the problem comes in. You cannot sell the left or any part of that plot within a week. And remember, here is an emergency. You need the 500,000 to take care of this medical bill or to get into this business opportunity that has come up. So in the current 2026 market, land market, unless your land is in a high demand developer zone, it would take up to almost 2 years to get a genuine cash buyer. And I'm saying this out of experience. And especially, please note that I'm talking of those satellite plots that the majority of Kenyans get lured into. It would take at most 2 years or longer. My example is longer because I've never managed to sell mine. So while your money is sitting there losing out on the compounding returns that you can get from instruments, liquid instruments like the money markets, the treasury bills, or rates. So it's more like a unit trust, but in real estate. It allows you to be part and parcel of that real estate development while you not getting involved or not owning it. So apart from the illiquidness of land, there are so many other costs that people don't consider. There are liabilities that people forget about. Number one, we have land rates. Owning a piece of land does not come for free. You have to pay annual rates that are called land rates. In January 2026, in major towns, the land rates actually went up. So that's a cost that people forget to factor. The second liability or cost is on the fencing and security. If you do not fence your land in Kenya, as soon as you buy it, someone will fence it for you. So if you buy your piece of land or plot and you leave it there, you will have issues. We have issues with squatters, and land boundaries will be the order of the day. So that's a cost that you must consider. The other cost that people forget is opportunity cost. Opportunity cost is the cost of foregoing one item for another. So take a scenario where you've bought a piece of land for 2 million. So if you took that 2 million and put it in fund that is earning you 10% per annum, you'd quickly be making 200,000 per year in passive income. If your land is not appreciating at a rate of 10% per annum, to cater for the land rates, to cater for inflation, to cater for taxes, you are actually losing money. Are we together so far? Remember, we are talking about certain specific places where you buy land, because the places you'll buy the land, especially what I've called the high developer zones. And currently, actually, for instance, the land prices in Nairobi inner suburbs rose by 1.22% in the last quarter, while in the satellites it was apparently 0.84%. I'm not saying that don't buy all land, just saying that be cautious where you buy the land. Be cautious of what's your age. At a certain age, you might not need to have a lot of your assets in land. So we're looking at how to avoid the land trap. Number one, you can follow the 30% rule. The 30% rule is that never put more than 30% of your total net worth in land. Just do an analysis, see how much of my net worth is in land. If it's more than 30%, you might need to liquidate some of that, sell it, and put that money in liquid assets. Okay. The second thing you can do to avoid the trap is buying in the right place, like I've said. So don't buy, for instance, don't buy a piece of land where you're told in the next 10 years a road will be passing by here. That project could end up being a white elephant depending on who comes into power in those 10 years. So buy a piece of land where the tarmac or the road is already being laid down. It could be a bit more expensive, but you will get value for your money because you will not get stuck up in some white elephant projects that you are expecting to add value to your piece of land. The other way you can avoid that land trap is you can look for rates. The ones I've talked about, the Real Estate Investment Trust. They are allowing Kenyans to own property at minimal rates without having to be the real owner of that real estate company. So in maybe one of my future videos, I will do more research and take you through the rates. But that's also an avenue that is coming up. So before you get into that land conversation, consider your age. Consider your financial situation. Because if the funds you have are limited, then you don't want to have all your money stuck up in the mud. You have children to take care of, you have school fees to pay, you have daily utilities to pay, you have short-term goals. Consider your financial situation before you put that money in the land. Okay. Then also Key to consider is your goals. What are your goals? Is it a short-term goal? If it's a short-term goal, then land might not be the ideal thing for you. But if it's a long-term goal, you're saying, I want to just do this for the next 30 years, then once I retire, I can use this as my retirement income, then that might work. So consider so many factors before you get excited. So ladies and gentlemen, you get caught up in land trap when you prioritize title deeds over financial flexibility. So don't let your wealth get stuck in the mud. Do an analysis of what percentage of your money or your wealth is in land vis-a-vis liquid assets, and then make the right financial decisions. So ladies and gentlemen, land is part and parcel of the asset classes we have, and we've discussed previously. Those are places you can invest in, but take care that you don't get caught up in the land trap. Thank you so much, and I'm just wondering, if you've not subscribed to this channel, what's stopping you from subscribing? Please consider, so that you keep getting updated on future videos that I do once in a while. Thank you.